Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. If you guys are looking for financial education, if you're looking for more information about commodities, click subscribe, give me the thumbs up button please, and join our community to ride this commodity bull market higher together. I know everyone's always wondering, what's the most leveraged commodity? Which one's going to give the highest return? And what should I be looking at? So I looked at the ratios in terms of these commodities in relationship to gold and how much they compress in a commodity bull market, given the last commodity bull markets. I've got some ratios and some leverage here of what I think is a possibility. It doesn't mean that these are for sure outcomes. What this means is that these are possibilities, and if history were to repeat itself, the leverage would be behind me to the price move of gold. So if gold goes up some amount, this would be the leverage to it. Now, you have to keep in mind though, oil doesn't hit this ratio when gold is at its peak. It hits the ratio when gold is usually a little bit lower. It peaks out a few years after all these commodities peak out. So you can't take the high of gold and then use these ratios. It's not like that. So some of these may be a little misleading, and I want you to understand that. So I'm gonna show you. I'm just gonna actually, you know what? I'm gonna do this. So I'm gonna shrink myself up a little bit more. Here's the ratios and leverage. I've got on the left-hand side, these are the current ratios right now. Oil is at a ratio of 23.7. So that's 1 ounce of gold can buy 23.7 barrels of oil. 1 ounce of, it takes 2 ounces of gold to buy 1 million cubic feet of natural gas. Watch the units there. The uranium is 1 ounce gold, 54.6 pounds of uranium, 1 ounce gold, 417 ounces of copper. 1 ounce of gold can only buy 0.61 ounces of platinum, and 1 ounce gold can buy 67 ounces of silver. Do I have that right? No. 1 ounce of platinum can buy 0.61 ounces of gold. That's what it is. After thinking about it, because I'm like, wait, that was a platinum to gold ratio that I did. Now, these are all right on the right-hand side. The math's all good. So if at market tops, where commodities peak out, oil usually compresses down to a ratio of 6. So that's a 1 ounce can buy 6 barrels of oil. If that were to happen, oil would outperform gold by a 4x. Natural gas would go up. The way I've got it figured here is it would take 15 ounces to buy 1 million cubic feet of gas. That's a 7.5x increase. Uranium, if it goes down to 5, would be a 10.92 times increase. Copper would be a 2x. Platinum would be a 3.27x. And silver would be a 1.9x if it were to hit these ratios. That means platinum could buy 2 ounces of gold. Silver is 1 ounce could buy 35 ounces of silver. 1 ounce could buy 200 ounces of copper. Now, keep in mind, I want to stress this, is these peak against gold at different times. So you can't take the peak of gold and say the return of oil is going to be 1/6 the price of the peak of gold. It peaks out much earlier in the cycle. Oil does, uranium does, and natural gas does. So it's not taking a peak of gold. So if you were to say if gold were to go to $10,000 an ounce, you might want to use a price of $3,000 or $4,000 for your gold price to do your oil, natural gas, and uranium calculation, because it peaks much earlier in its cycle. The ratio peaks earlier in the cycle in relationship to gold and silver's peak. So the way that I look at this, and the most leverage, and I'm going to show you another Excel spreadsheet that I did with leverage. Of these, and just looking at it, I would say oil, natural gas, and uranium provide very good leverage. And I would say that copper, platinum, and silver, I think they all provide very good leverage, because copper, platinum, and silver provide, well, they provide the leverage for the entire move of gold. The other ones peak out sooner, so you're multiplying it times a much less gold price when it peaks. So the play here, I think, would be oil, natural gas, and uranium they're gonna take off, and then later on, copper, platinum, and silver are going to take off. Another thing to also keep in mind is that the mining companies of gold and silver, they usually peak mid-cycle. They don't run the entire cycle length. So if you have this very large move in gold and silver, the ratio of like the Huey to gold ratio, or the other ratios, whatever gold and silver in relationship to gold, are going to peak some years before the actual peak of the physical metals. So it's not a super direct, easy direct way where gold peaks out and all these peak out. It doesn't work like that, unfortunately. Now, just to show you some of the ratios and where we are at today, in mid-year 2008, oil surged to a 6-to-1 ratio. And remember, gold peaked in 2011. So this was 3 years before the peak of gold. And it said mid-year 2008, as oil prices surged, gold scraped a historical low at a 6 multiple. A half year later, the ratio had rocketed to the 24x level after massive deleveraging sent oil prices down $100 a barrel. I think it was so that'd be at $40 a barrel. Over the longer term, say the past 4 decades, the average multiple has been 15x. I've got the star up there. That's where we're at right now. It's at 23, 24 is the ratio right now. It's still of good value, but it was not as good of a value as it was I'd say 6 months ago. Looking at natural gas is really cheap. It is cheaper going way back. So we are at an anomaly for how cheap natural gas is. And natural gas is cheap in relationship to oil as well. I think natural gas is an excellent opportunity for investment. Absolutely excellent. That would be one area that I would be focusing my efforts on, is natural gas. There's the line, the star of where it's at. Extremely low down here. Now, looking at some of these other ones, this is the uranium, gold to uranium price ratio. We have insane possibilities for a move lower in this ratio. This is at 5 down here. We are way up almost at 60. It's at 57. And we can compress all the way down to 5. That's over a 10x. That's a very good compression. It is still incredibly undervalued, uranium. Gold to copper ratio, there's where it's at right now, the star. It's just slightly cheap. Platinum is very, very cheap in relationship to gold. It's probably the cheapest precious metal of all of them. I am a huge platinum bull. I think platinum is in an excellent spot, even right now, to be cost averaging in my opinion. And it's a very good value, very good value. And then the silver, we have come down quite a bit from 1 over 100, and we're compressing down to 68 is where we are today. And 68 is an okay valuation. I wouldn't say it's great. I wouldn't say it's bad. It's just okay. So of these, I think platinum, natural gas, and uranium are the best investment opportunities when looking at assets priced against gold or assets priced against assets. It's some of the cheapest on a historical basis for valuations. Those sectors are. Now, I'm going to go into the leverage to show you how much leverage there is in these investments. So what I have here, I'm just going to move it over like this. So I have a platinum price projection here. And the way that you want to read this is if the ratio goes up, if platinum outperforms gold, this is the leverage that you get. This is from a left, you read this left to right. If gold goes to 10,000, it's the green line and it compresses upward like this. That's the leverage that you get. The more vertical this line goes, the more leverage you get on the compression of the ratio. So what's most important here is the gold price. If you stay at 1, the gold price goes up like this. So if you have a $2,000 gold price, you're going to get a $2,000 platinum price if the ratio compresses to 1-to-1 ratio. Here it's 5,000 is 5,000, 10,000 is 10,000, 15,000, 15,000. But if you can compress the ratio, that's where the big money's made if gold goes up. So if gold goes to 10 grand and you compress, you can get some pretty ridiculous levels of valuations for platinum. So if it's a 2x and it's 10,000, it's $20,000 for platinum. Now, the more this thing goes up, the more leverage you have. These are read from right to left. That's just the way when you compress the ratio, that's how this thing likes to chart it. So if we're at 57, which is way down here, if we compress against gold over time, you can see it goes just ridiculous and goes vertical. It goes exponential if you can compress below 10. That's when things start to go exponentially up. So if we get a $10,000 gold price, or maybe if it's 10 at the max, maybe I can use it like a 2 or 5 somewhere in here. I think that the uranium price could potentially go to $500 or $600 a pound if it compresses like it has in history, and gold were to go to like 3 or 4 grand. I think that's a high possibility. $600 seems like a pretty solid number, and it seems very high, but that's history repeating itself. This isn't anything new. Every time gold hit some other highs in its past, gold was at lower valuations, and it compressed quite dramatically. I don't know what the future is going to hold, but this uranium has a very large leverage to the price of gold. It is one of the most leveraged commodities. Moving on down, oil is also extremely leveraged to the price of gold. Moving on up, I think it's possible if gold goes between $2,000 and $5,000, that oil could easily hit multi-$100 per barrel of oil. I don't know the exact price, but it could be $300, $400. And I know people are going to say, well, how can people afford it? You're not thinking in terms, you're thinking in terms of today's dollar valuations. Think of future dollar valuations. Think of inflation. Think of getting paid a lot more money. This isn't all things aren't going to remain static. It's going to be dynamic, but it's going to also cost you more on a relative basis. So that's oil. If you go back and forth, uranium has a little bit more leverage than oil does, but it's very close. And natural gas probably has the most leverage of all of them if the ratio can compress below 5, which is very rare. So don't expect that this tail end to actually manifest itself. It may not. We may be in this range over here, which is still good compression, but it may not compress all the way back up. So my take on this, if you want my take, I'm spreading across all of them. I don't know which one's going to be the winner. And you're really going to have to speculate and get it right if you only choose one sector. I don't like to do that. If we know natural gas is a good opportunity, we know oil is a good opportunity, we know uranium is a good opportunity, silver, platinum, and copper are good opportunities. I invest in all of them. My approach has been use my portfolio allocation as my way of reducing risk. I go 1 to 5% in each individual stock position. I also go into all of these sectors. I go into royalty companies. And the way that I usually do this is just me, my opinion only. I don't want to influence. Do some research on this. This is just my opinion. I don't want to totally guide someone. I like the royalty companies and the metal companies because oil is an input cost to mining companies. So gold and silver royalty companies, copper royalty companies like Nova. Some of the gold ones would be Wheaton Precious Metals, Franco-Nevada, Osisko Gold Royalty, Sandstorm Gold, Ely Gold, Teuton Resources. Those are all very good. I like those types of royalties for metals. For oil and natural gas, I just buy the exploration and production producer companies. They're the ones that are going to be leveraged to the price move. I go after those. I don't go after royalty companies in oil and natural gas. I go after the exploration and production companies. SM Energy, Centennial Resources Development, Callan Petroleum, Athabasca Oil, Birchcliff Energy, Crew Energy. Let's do Northern Oil and Gas, Oasis Petroleum. Some of these other ones that I've talked about recently in natural gas, like Southwestern Energy, CNX Energy, Antero Resources, and there's more that I'm forgetting. Contango Oil and Gas, MCF is the ticker symbol. I'm in all of these. FANG, F-A-N-G. I'm in a lot of oil and natural gas. I'm in a lot of it because it got so cheap that I piled in. I am now accumulating what I think is the best opportunity, which is uranium. I'm piling in uranium. I piled in 2020 in October, November. I piled in there. I'm continuing to cost average in to natural gas, into uranium, and I don't have as much metals. If I buy the metals, I'm usually buying royalty companies. I'm adding into Nova Royalty quite heavily, and I'm going to continue to add into all these. This is not financial advice. It's only financial education. I just gave you my opinion. Please research it yourself. I am the most confident in oil, uranium, natural gas, copper. The ones that I have in this here are the ones that I really like. Tin is another one. I just don't know of a great way to play tin. Alphamin is the company that I own, and that's the only company that I own in the tin play. Now, rare earth metals may also be ultra leveraged to all of this. It may dwarf it all. So I do have a position in rare earth metals, and my largest position is in REMX ETF. They are heavily invested in rare earth metals that are producers in China. So I went that route just because I can't get those companies. Therefore, by default, I just went into REMX, and that's where I hold my good, quote, chunk of rare earth metals. I also own Appia Energy, APAAF. That's another one I own that has rare earth metals. UU, but it's not a very big stake. But APAAF is the one that I own, and that REMX. That's my biggest position, REMX. If you guys like this content, please give me a thumbs up. Hopefully this gives you a little bit more information on the commodity bull market. I do own fertilizer companies like Mosaic. I own ADM, which is a agricultural company. I haven't looked at the other fertilizer, Intrepid Potash. I think it's IPI. That's in one of the portfolios that I hardly ever look at. It's not in my main one. And I do own, some of those fertilizer type companies. They've done decently well, and I'm going to continue to hold them. I don't think that they're going to be as leveraged as some of these guys. So if you were to do a bar, if you were to say what is the most leveraged way to play this, I would probably say a developing company in uranium is probably one of the most leveraged ways, and I own a lot of those. Exploration uranium companies can be highly leveraged to the price of uranium if they find something. That's a big if. There's a lot of risk there. The royalty companies in the metals is where I like to put my money. Physical precious metals, I like that one a lot because the risk-adjusted returns are ridiculous because there's very low risk in them. And highly leveraged or highly indebted oil and natural gas companies are gonna kill it, especially if you bought them at the bottom. If you're looking for some companies right now, I would look into the energy service companies. They are still way down there. and I think they can be very good, undervalued opportunities with high leverage. So some of those energy service companies, you could say deep sea drilling or just anything that's in the ocean drilling energy service companies are probably going to be pretty good. They are very low. And I like a lot of those picks as well. If you guys like this content, please give me a thumbs up. Any questions or comments, put it in the comment section below, please. And thank you for listening. This is Finding Value.